Hello everyone, today I'll be discussing the Wall Street crash of 1987. To give a brief overview of the crash, it is also known as Black Monday and occurred on Monday, October 19th, 1987. It was a global market crash impacting countries around the world. But the country that we'll be discussing today is the United States, where the S&P 500 and Dow Jones both fell by over 20% in value due to the crash. Here is Dow for the year of 1987 to visualize how extreme the crash was. You can see that for the majority of 1987, things are trending upwards, showing that things are going well in the stock market. However, when October 19th hits, it falls so drastically that it goes to pre-1987 levels, indicating that almost a year's worth of stock growth was lost due to the crash. In fact, looking at the grand scheme of one-day crashes across all of history, Black Monday was the single largest one-day drop ever. In fact, it was almost twice as bad as the worst day during the Great Depression in 1929. The crash was caused by two primary reasons, being technical and non-technical issues. In terms of non-technical issues, leading up to the crash, as previously mentioned, there was a bullish market, meaning things were going upwards on the stock market. However, outside of this, there was a lot of discussion about emerging markets in Asia, the value of the American dollar, and whether the American economy was sustainable. Additionally, there was a lot of overvaluation on the market, meaning that many stocks were valued at a price that they were not actually worth. And this eventually was part of the catalyst for the crash in 1987. On the technical side, which I will go into further detail on another side, the main issue was program trading and specifically portfolio insurance. Program trading is the programmatic buying and selling of stocks for the usage of computer-generated algorithms, although they are monitored by humans. And portfolio insurance is one type of program trading where the program short sells stock index futures when values decrease. During the crash, these programs essentially went haywire and went into panic mode as they saw other programs selling, so they sold, but then those other programs saw that they were selling, so they sold, and this created a cyclical cycle of selling, meaning that almost all stocks on the market were being sold at once and no one was buying. This not only decreased the value of the stock market by 20% as previously stated, but it created a flow problem as there were no bids to actually buy the stocks that were being sold. And because the reason there were so many being sold was not only because of portfolio insurance, but also when stocks hit a certain value, many stock traders put in stop-loss orders, which basically sell a stock when it hits a certain value. But because it kept falling, stocks kept being sold, but no one was actually buying them, because everything was trending downwards, meaning that none of these stocks were actually able to liquidate when they were trying to be sold. In effect, the entire thing was actually just a domino effect, because leading up to the crash, there was selling pressure at its highest peak, but then when they actually started to sell, the programs kicked in, and then they triggered the cyclical cycle as I previously mentioned, but there was nothing in place to actually handle this level of, or this volume of sales at once, meaning that bids were basically vanishing across the stock market at the same time, and there was no one actually able to buy all of these stocks, creating a flow problem as previously mentioned. And I think it's important to note here that this was across many different countries. In fact, the United States wasn't the most impacted. One of the most impacted actually was New Zealand, which fell by over 60% due to this crash. You might be asking yourself, well, if there was nothing in place to actually stop these programs from selling, they should just put something in place to stop them when they go to a certain amount. And this is exactly where circuit breakers come into play. Circuit breakers essentially pause trading for a certain period of time when values decrease by a certain amount, and they are created to curb panic selling and reduce the chance of a sudden major stock market crash. They are extremely important because they give time to stock traders to make adjustments and to calm down from panic selling, which slows the momentum of the panic and this slows the momentum of the stock market value decrease when there is something going on in the economy. One example in recent times where circuit breakers have been used to great effect was earlier this year when the shutdown started reaching the United States. On March 9th, the market fell by over 7%, mostly due to oil, which triggered a Tier 1 circuit breaker to take effect. If you look at the graph, you can see that the circuit breaker prevented the stock value from continuing to plummet and subsided most of the panic that was occurring at the very beginning of the day. This is just one example of where circuit breakers are used, but you can see that they are extremely valuable in actually preventing there from being a major rapid stock collapse on one day. And that's why it is important that we continue to innovate and bring in new technologies like this to improve the technologies that we are using on a day-to-day basis. Thank you.